Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation, bringing you another 2-minute drill, lessons in valuation, subscriber request series. Now, I want to make it real clear. These are not stocks that I'm necessarily recommending. These are stocks that subscribers have asked to see. And since I'm going to do just a short video, I'm going to do a very high-level look at these companies. Today, we're going to look at Evolution AB, a Swedish company. One thing I really like about it, it has almost no debt, less than 2% debt. It offers an earnings yield of 7.51% and a dividend yield of almost 3%. But here's the key. The company's growth, going back to the beginning of 2018, has averaged over 35% a year. And so I'm using a PE ratio of 35, Peter Lynch's P equal growth rate, as the fair value ratio. The normal PE ratio has averaged about 29, so it's been a little discount to its normal growth rate, or its actual growth rate. Now, here's the key. When I put price on the graph, you can see that the stock traded at this 35 multiple or right around it for the first couple years. Then it got really overvalued. But note the growth rate, 77%, 104, 69. Then we had a 31% growth rate, or about half of what we did in 2021, and the stock was overvalued and vulnerable, and it corrected pretty dramatically. Then, we went back with 30% and 29% growth, and the market, the PE got low. The market seemed to respond to that. And once again, the stock fell towards the end of 2023. And then as we come into 2024, the stock really had just really poor performance. Our growth rate had dropped to 13% and expected to be flat next year. And I think that justifies, or at least creates, the reason why the value is currently only trading at a PE of 13, which is much lower than its normal PE and much lower than its earnings justified. Since this is a dividend-paying company, I like to look at two other metrics: operating cash flow. And here I'm not going to concern myself with price. What I want to see is the orange line, or the cash flow, being much greater than the dividend. And you can see the dividend is the white line on the graph. And note the company's paying out about 30%. Last year it paid out 30% again, expected to pay out about 44% for this year going forward. But my point is, the operating cash flow is significantly higher than the dividend, which means it's covering the dividend with operating cash flow. And then the all-important free cash flow to equity is also significantly higher than the dividend. So looking at the company at this valuation, no matter how you measure it, I think it looks very attractive and worth your research time. Thanks for watching. This is Chuck Carnevale, aka Mr. Valuation. If you like the video, subscribe to the channel, subscribe to our FastGraph. If you haven't already, I don't think you can even be an investor in stocks without it. Thanks for watching.